is 5 a.m. in New York City. Good morning. I'm Lizzie Burden with your Bloomberg Brief, standing in for Danny Berger all week. Here's what you need to know. A new tariff threat. President Trump may impose a 50% levy on Brazil, citing the trial of the country's former leader. Uncertainty jitters. Traders remain cautious as they await a fresh catalyst for the markets. And AI keeps its crown. TSMC revenue and the release of Musk's Grok 4 show that there are no signs of slowing. Well, trade trumps tech, at least in the markets this morning. Yes, we had Nvidia becoming the world's first ever $4 trillion company yesterday, but Nasdaq futures are in the red this morning, ever so slightly, yes. But look, we're marginally weaker across the board as we head towards the Wall Street Open because it's the tariff headlines that this market is focused on right now. We've got a date for those copper tariffs, August 1st, and we have those 50% levies announced on Brazil, and that is not who we were expecting it to be thrown at least at that level, given Brazil was in deficit for trade with the US last year. Now look at your bond market as well, because we had a pretty strong auction, the second of three for treasuries this week. The third comes later on today. That helped the rally along with the divisions at the Fed, as we saw in the FOMC minutes. But you're looking at the 10-year now at 4.34, keeping an eye on copper as well, higher again today at 561 cents a pound. But let's get to your pre-market movers. Joe Easton's here with that. Joe, what's on your mind?
Hey Lizzie, there is only one place to start today, and it is Rice Krispies and Cocoa Pops. We've got WK Kellogg jumping 49% in the pre-market as Ferrero comes in with a potential bid, according to a Bloomberg exclusive. It could be worth around $3 billion, and it is a massive premium. Now, I've spent the morning researching on all the brands these companies make. It is Ferrero, behind Ferrero Rocher, of course, Kinder Eggs, Kinder Bueno, all the chocolate brands we love. Buying into Kellogg, the company previously behind Pop-Tarts as well. I haven't had a Pop-Tart for years. But moving on to the crypto and blockchain space, Circle up again. This is a company that's really rallied hard, and we have got reports of Jack Ma's Ant Group potentially teaming up on a stablecoin venture for the company. So we're rising once again, up close to 4%. And then finally, Oracle getting an upgrade today. This is all about the AI exposure, of course, the continued theme on that and the software. We are getting an upgrade to overweight over at Piper Sandler. As usual, check out the Before the Bell opening wrap on the terminal for a fantastic wrap-up of all this news and more, Lizzie.
Joe, I had you down as a Weetabix man. You always seem to have had your Weetabix in the morning. But thanks for the update. We'll see you in half an hour. Joe Easton there. Now, in just moments, Wei Li of BlackRock and Frank Monkam of Buffalo Bayou are going to join the show for their reads on the current market uncertainty. We'll also, of course, get a look on the chip sector. Herbert Diess, the chairman of Infineon, joining us from the Bank of America Breakthrough Tech Forum. That's happening in the UK. Let's turn our focus now to this uncertain landscape. Wei Li of BlackRock writing, quote, immutable economic laws on global trade and US debt limit just how quickly the world can change. While we see long-term macro anchors weakening, we think that mega forces like artificial intelligence provide a new anchor. And I'm pleased to say that Wei Li, Global Chief Investment Strategist at BlackRock, joins me now. Good morning. Nice to see you. I want to talk about Nvidia here because, as mentioned, we've seen it becoming the world's first $4 trillion company. But on our MLive blog this morning, we have them writing that it's actually the avatar for market FOMO. So I wonder, can traders really afford to look through the tariff headlines and focus on AI, as you suggest?
In the coming weeks, tariff headlines are likely going to drive significant market volatility and narrative swings. But this is where the immutable laws, considerations for US debt sustainability, and also considerations for global supply chain and the disruption of which that can lead to significant consequences to access to critical goods. So this is where the immutable laws come in to try to help shape or have an understanding of where we're heading towards in terms of the landing spot, which is why even though tariff headlines are going to fly around very uncertain, we do believe that immutable laws can govern at least where we could be in the near term, because it will constrain how quickly things can change. Now, back to technology, back to AI, you talked about NVIDIA, but the broader trend is technology is doing the heavy lifting of earnings growth. You look at tech in particular, the upcoming Q2 reporting season that is starting, it is expected to deliver about 18% year-on-year growth versus the broader S&P 500 expected to deliver 5%, 6% year-on-year growth. So it is expected to do the heavy lifting, and it is not a surprise that this is still a somewhat concentrated market because earnings delivery is very concentrated. The last comment I would make is that we're currently risk on because focus is also going to shift towards deregulation, unleashing animal spirit, and tax cuts as well, not only just on tariffs. And this is important in shaping the kind of the landscape of H2 investing.
Yeah, look, NVIDIA is now worth more than all of the publicly traded companies in Germany. Is NVIDIA priced to perfection, or is Europe too cheap?
Maybe NVIDIA is priced for quite a perfect outcome and AI implementation. I would also say that Europe has turned around in terms of catching up with US counterparts so far this year. We have seen performance both in local currency and also in dollar terms outperforming the US. So that turnaround has already taken place for a sustained outperformance of European equities over US from a top-down perspective. We need to see economic surprises in Europe outpacing that in the US. We don't see that just yet. We need to see earnings momentum in Europe outpacing that in the US, and that is not happening either. I give you one example. Q1 reporting that just wrapped up. US delivered, S&P delivered 14% year-on-year growth. Europe delivered 2%. So we have seen kind of the bottom rally, but for a sustained rally, we need more conditions to be in place. They are not quite in place just yet. You talked about public markets, but private market plays a big role in implementing AI tools. So if you think about companies with more than $100 million revenue in the US, actually 80% of them sit in private markets. In Europe, that percentage is even higher. Companies are staying private for longer. Right now, the average of IPO companies is about 14 years. 20 years ago, that was 8 years. So companies are staying private for longer to really get exposure, pure play to AI. We got to think about private markets too.
But as we think of earnings, and we are, of course, in the foothills of earnings season, it's interesting that you're overweight US equities, but you prefer euro area government bonds to treasuries, right? And you say that that's because you think that the sticky inflation is going to stop the Fed from cutting rates that far. Isn't that same inflation going to show up in earnings and valuations?
That is actually a very good question. So far, we have had a few months of reasonably well-behaving inflation. Expectation was for tariffs to show up in the inflation numbers. They haven't done so meaningfully, but we do know that they're going to show up somewhere, right? So are they going to show up in the company margins if it is not showing up in the inflation prints? Maybe companies are eating the tariffs impact, or are they going to show up in the exporters' revenue as well? So there is a huge amount of uncertainty in terms of where the cost is going to show up for the tariffs, which is why we're paying close attention to earnings season to understand if companies are adjusting their prices already or they are waiting for some of the clarities before they actually do that. But this is really an environment of being active because we're focusing on companies that have pricing power, that have the ability to pass on some of this increase in cost rather than across the board. So again, this is an environment for being selective, and our study shows that high-performing top quartile active managers are being rewarded more in this environment compared to the 10 years prior to a pandemic, which goes to show previously it was an environment of rising tides lifting all boats, and now we have to be more selective. And if you're good at being selective, it's more rewarded. That being selective is more rewarded. The last comment in response to your observation that we actually favor European government bonds over US government bonds long duration right now, it is to recognize that there's more room for ECB to maneuver because the inflationary pressure is less, and the fiscal trajectory in the US, you think about the big beautiful bill and the term premium, that needs to reflect the higher fiscal trajectory that favors international duration over long duration US government bonds. But we think that US exceptionalism favors US corporates, and this is why we are overweight US equities.
But where you think that the Fed's going to be limited in how much it can cut, right? Do you not think that the president's pressure on the committee, and Powell in particular, is going to have any effect?
Well, we actually see markets pricing now somewhere between 4-5 cuts by the end of 2026. We think in terms of the macro environment, what are warranted in terms of number of cuts is less than that. So maybe markets are getting quite carried away in terms of the Fed needing to cut quite a bit more because of the maybe some pressure, but also maybe inflation while behaving for quite a few months, giving markets confidence that inflation is going back, but that's not what we believe. Now, one thing I would say is if markets are pricing in more cuts because it believes that there can be influence on the decision of the Fed, then actually that would push up term premium as well, because international investors would assign a higher term premium to long bonds if they believe the independence of central bank is affected, right? So all of that still points to let's be thoughtful about the level of long bond yields that are reasonable in a whole portfolio context, and we actually prefer in terms of yield pickup, the front end and the belly of the curve rather than long duration because of the term premium dynamics, especially as you throw in the consideration for the influence over the Fed, although right now it's more the macro environment that is driving the market pricing.
Okay, Wei Li of BlackRock, always a pleasure to have you in the morning. Thanks for starting your day with us, Wei Li. Now, to some other stories trending on the terminal this morning. The battle for top AI talent is heating up, with sources telling Bloomberg that Meta has lured one of Apple's AI chiefs with a pay package worth over $200 million. The pay package is in line with other major hires for Meta's new superintelligence team, focused on building AI systems that can complete tasks as well as, or better than, humans. And staying with tech, TSMC's revenue rose a better than anticipated 39% in the June quarter, thanks to the AI spending boom. Investors have piled back into AI-linked companies, shaking off a funk that settled in after China's DeepSeek cast doubt on spending earlier this year. While Nvidia is fueling its growth, TSMC remains reliant on Apple and smartphone makers for most of its business. And Elon Musk has finally unveiled Grok 4 just months after releasing its previous iteration. The release comes after XAI was forced to remove inappropriate Grok posts from X that included anti-Semitic comments and replies to users. Well, Bank of America's breakthrough tech dialogue is taking place in the UK today. BTech Europe anchor Tom Mackenzie is on location and he joins us now. Morning, Tom. What have you got in store for us?
Lizzie, good morning from the bucolic English countryside, of course, where the conversation inevitably is about artificial intelligence. I was just listening in the building behind me to a conversation as well about longevity, so combining AI with healthcare and how that could lead us to longer, healthier lives. We're going to be speaking as well in the back half of the show to the chairman of Infineon, talking of the chip space, industrial chips, chips for automakers. Herbert Diess, former CEO of VW, now chairman of Infineon Technologies, his views on how AI has been integrated into that business, but also how they hope to get an advantage and lean into that AI demand. So that story, that interview is coming up with the chairman of Infineon Technology. Stay with us. This is Bloomberg.
We know that AI is going to transform all businesses and all industry and the entire tech industry. And these are trillion-dollar companies, et cetera, at the high end, and the whole stack, all the way through down into billion. So saying, hey, this piece of talent is a risk-adjusted bet that makes a difference in that's just a risk bet.
Joining us now is Bloomberg Tech Europe anchor Tom Mackenzie on the ground for us at the Bank of America Breakthrough Tech Conference in the sunny UK. It's raining here in New York. I hate to tell you, Tom, I don't know why. But look, Tom, you're on the ground there. And the question that we've been having so far on the programme is whether investors are getting complacent, piling into big tech again. But, you know, is it that they're ignoring tariff headlines that they shouldn't be?
And look, Lizzie, this is a question I put to the Bank of America International President Bernie Mensah, who, of course, is convening this dialogue, the Bank of America Breakthrough Technology Dialogue. It's Chatham House rules, so the events behind me, we're not reporting directly on those, but I'm able to listen in. Look, what Bernie was saying, what Bernie Mensah, the International President of Bank of America, was saying around the story in terms of the stock exuberance that we're seeing at a time, of course, of that volatility around tariffs and trade, when we think about the 50% that's been flagged for Brazil, when we think about the 50% that's been flagged for copper, is that there are other factors at play here, of course, and that these are markets that have started to learn, started to get a framework in terms of how the tariff and trade story ultimately may settle. Very different environment, he says, compared to Liberation Day, April, when you saw, of course, that huge sell-off in the markets. These are stock markets that have learnt to read the tea leaves a little better, he was saying, in terms of how this tariff story may unfold. Not to say that there isn't now volatility, but he was making that piece and that case around what we're seeing in the markets now. Of course, we have to think about the impact in terms of inflation. And it was clear from speaking to Bernie Mensah of Bank of America that he thinks we are still some way away from seeing that inflation come through. He thinks earnings and the next quarter of earnings will be crucial. His corporate clients are saying that they are absorbing some of that tariff impact, but he also thinks inevitably some will also be passed on to consumers in terms of higher prices. So that's on the macro level. On the micro level, there is still huge. It's hard to move away from the AI conversation here at an event like this. They are glued to their seats in the venue behind me, talking and hearing from executives, for example, from OpenAI, talking about where AI takes us from here, what that journey to artificial general intelligence looks like, and how it's going to impact sectors and businesses globally, Lizzie.
Yeah, and when we look at TSMC revenue surging again this morning, when we hear about NVIDIA, the first ever $4 trillion company, surely DeepSeek seems like a distant memory. Is that the feeling on the ground there when you're speaking to people?
I think the view on the ground is that DeepSeek is an example of how you can iterate more cheaply, more efficiently, and make this technology spread more broadly at a lower cost point, and underscoring the fact that it is going to be transformational technology for industries, sectors, and economies globally, but that the spend to get there in terms of data centers and chips at the highest level, at the highest point, where you're really getting to the cutting edge for large language models like OpenAI. The case from OpenAI would be that that spend on those data centers, those cutting edge GPUs, of which NVIDIA, of course, still has 90% market share, is still really important. So there's a number of different elements to this. DeepSeek, of course, has not derailed the innovation. It hasn't derailed the CapEx spend. What it has done, arguably, is opened up more venues for possible innovation for the companies and the executives sitting in the building behind me.
All right, Tom Mackenzie, don't miss, thank you, and don't miss the next episode of Bloomberg Tech Europe, featuring an exclusive interview with the SAP CEO, Christian Klein. Catch that programme, hosted by our very own Tom, this Friday at 6:30 a.m. UK time. Now, coming up on The Brief, a look at what else is making headlines around the world, including a possible deal with the cereal maker Kellogg. This is Bloomberg. This is Bloomberg Brief. I'm Lizzie Burden in New York. Time now for your front page news, a look at what's making headlines around the world. And first up, on the front page of the New York Times, officials in Kerr County, Texas, have struggled to provide answers about their response to a devastating flood that swept through nearly a week ago, killing at least 120 people statewide. Texas Governor Greg Abbott was pressed about possible lapses in disaster preparation, and statewide 173 people remain unaccounted for. Next up, let's go to the front page of the Wall Street Journal, and the ex-CEO, Linda Yaccarino, has stepped down from her role and was allegedly months in the making. She told people close to her that the recent return of some advertisers and the merger made it a good time to depart. Current and former employees say that her position at the company appeared increasingly tenuous after clashes with management. And splashing the Financial Times, Ferrero, the family-owned Italian food group, is in advanced talks to buy the American breakfast cereal company Kellogg. The takeover could be announced as soon as this week and values the company at a significant premium to its market value of $1.5 billion. There is no guarantee a deal would be clinched and timelines could slip, but Kellogg and Ferrero haven't immediately responded to requests for comment. Now let's check in on these markets. Let's look at your futures picture because it's a little negative this morning, just a touch. Despite the good news about Nvidia, we're focused here on the tariff headlines. A 50% copper tariff to start on August the 1st, the 50% tariff on Brazil as well, far higher than expected. We've got the 10-year there at 4.34 ahead of that third of three Treasury auctions later on. But coming up on the programme, we'll dissect the uncertainty in markets with Frank Monkam of Buffalo Bayou. That's next. This is Bloomberg. It is 5:30 a.m. in New York City. Good morning. I'm Lizzie Burden with your Bloomberg Brief, standing in for Danny Berger. Here's what you need to know. A new tariff threat. President Trump may impose a 50% levy on Brazil, citing the trial of the country's former leader. And uncertainty jitters. Traders remain cautious as they await a fresh catalyst for the markets. And finally, AI keeps its crown. TSMC revenue and the release of Musk's Grok 4 show there are no signs of slowing. Well, it is tariffs trumping tech this morning when we look at these markets. Futures pointing lower across the board there, just a touch really, but we've had these trade threats being ramped up by the president. A date for the copper tariff of August the 1st, these new tariff letters including 50% on Brazilian imports. That's one of the highest levies so far. So yes, we had Nvidia becoming the world's first ever $4 trillion company, but even there we've got Nasdaq futures down 0.1%. In your bond market, we had treasuries jumping yesterday thanks to a strong auction. We get the third of the trio today, but that overnight rally enhanced by the division at the Fed, illustrated in its June minutes over how much tariffs are going to hit inflation. So the 10-year yield now though at 4.34, and we keep an eye on copper because of those tariffs now at 561 cents a pound stateside. Let's get to your stocks to watch now. Joe Easton's with us with that. Joe, what are you watching?
Hey Lizzie, so we've got a big deal in the cereal space this morning. We got WK Kellogg getting a takeover bid from the Italian privately held company Ferrero, the firm behind Ferrero Rocher and all those delicious chocolate brands, going in for the maker of Rice Krispies at around a $3 billion valuation. That stock up 50% in the pre-market. Then over in the crypto and blockchain space, we've got news of Jack Ma's Ant Group doing a potential deal with Circle to use one of their stablecoins on their platform. That's boosting that stock. Remember, that stock IPO'd at about $30 a share. We're already up to above 200 on that one. Keep an eye on that one. And then also an upgrade for Oracle over at Piper Sandler. This is all related to the AI, the open AI trade. They think it's going to benefit. Keep an eye on Oracle in early trading this morning.
All right, thanks, Joe. Now, the Fed minutes show that the emerging divide among officials over interest rates is being largely driven by differing expectations on how tariffs are going to affect inflation. Frank Monkam, head of macro trading at Buffalo Bayou, joins me now for more. And it's interesting in your notes that you say, ironically, the pressure that the president's putting on the Fed is going to raise the burden of proof for easing when it comes to the eco data.
Absolutely. I think the Fed is in a position now where they've shifted a little bit from just being data dependent now to providing a bit of forward guidance, right? It's forward guidance around the tariffs. So what they're saying is that tariffs are really a moving target. They have to kind of wait and see pass-through effects of that before they could have more clarity on policy. Clearly, the direction of travel for them is to want to ease. I don't think there's any kind of substantial probability of the Fed really hiking anytime soon here, but I think they want to ease. The problem with that is they have to protect the forward guidance indication, which is they want to see how tariffs actually pass through. And secondly, with all the pressure coming from Washington, the Fed has to be really careful. It is not to make sure that its independence is not at risk here.
But we were talking to Wei Li earlier, and she was saying, you get that pressure, and the market moves anyway when you look at the 10-year yield.
Yes.
Especially as we've got everybody seeming to audition to be the next Fed chair. Not everybody, but some.
Yeah, absolutely. The 10-year here, it's actually very interesting that you're mentioning that, because I think that we traded through the first half of the year with all the tariffs rhetoric, all the policy rhetoric that's been litigious to say the least. But as we get into the second half of the year, everything's at all-time high, stocks, Bitcoin, everything, credit spreads are tights. But if you look at the bond market, that's the one market that really hasn't made a decision, right? The range it's been 4% to 480 here year to date. We're right in the middle of it here, around 435, 440. So the 10-year really, to me, is going to be the main drive. It's going to be really the dog kind of wagging the tail here in macro space, because he really hasn't decided where he wants to go. We have to kind of see where the vigilantes really want to take this. And with the OBBB, the one big beautiful bill now having passed, if everything were to hold steady, labor market steady, inflation kind of in check, I think the bond market is going to go back to focus on this fiscal outlook, which is it's clearly pointing towards probably higher yield before we see low yield here in the second half of the year.
I mean, is the reason that we haven't seen any sign of the bond vigilantes because actually the bond market is confident that Trump's going to get tariffs to pay for his tax cuts?
Sure. I think the one thing you have to understand about the vigilantes are patient, right? They ingest the data, they digest it, they take time to really make a decision.
It's not so sinister.
No, it is not. It's not sinister. But I guess the point I'm trying to get at is if you really look at the way the bond market is traded over the latter part of this recent cycle here, it looks like a broken market in several ways. Right? I mean, even when we saw the big drawdown in the equities market, the bond market really hasn't reacted as a safe haven asset. We've seen that flow going into gold, going into other spaces. So that to me is a big change. The dollar obviously is a similar story here, where we've seen the dollar trading down to the lows here, despite everything that we've seen. And I think there's a really tectonic shift happening here in the bond market and the dollar that we need to keep an eye on. And like I said, the vigilantes are really patient, so we have to respect that.
But we've seen some glimmers of hope for the dollar this week, right?
Yes.
Is that story overblown, the dollar weakness story? Is it time to leave the party?
No, I think one of the things that's been happening, given the repricing of sovereign risk in the U.S., so to speak, and you've heard rhetoric around U.S. exceptionalism, is that dead or not? And initially, people thought maybe that was going to be reflected in the equities market. It hasn't. But what's happening is been reflected in the bond market, right? Rather in the currency market with the dollar. Right, so people are, buying U.S. assets on an unhedged basis. So that's basically a headwind to the dollar. So I think there's a structural bearish story for the dollar that's there. The reason why I think one has to be careful here in the very near term is that the dollar has been very overextended to the downside. It's overstretched. It's been oversold, so I think it's probably primed for a bit of squeeze here, which might have implications with some of the other risk assets, particularly commodities, but providing maybe a bit of a headwind there if the dollar were to rally. But I think the structural story for the dollar to go lower is still there.
But staying on currencies, when you look at the Brazilian real's reaction to the tariff news, does that suggest that we're too calm about trade?
I think we are. Part of it probably is a bit of seasonality here. Remember, this is summer, summer lull in a way in terms of liquidity. Things are a bit quiet. But like I said, even going back to what you mentioned earlier about the vigilantes, it's the same story. Things feel a little quiet now, but I expect things to really pick up kind of cross-asset once we get into Jackson Hole in August, and definitely by Labor Day in September.
Oh, the calm before the storm.
That's right. That's right.
Sowing the seeds for that. Frank Monkam of Buffalo Bayou, so good to have you with me around the desk this morning. Thanks for coming in. Yep. Well, coming up on the programme, has Trump picked his next fight with Brazil's Lula da Silva? We'll take a look at the tensions next. We'll also get a reading on the chip sector as Herbert Diess, chairman of Infineon, joins us from the Bank of America Breakthrough Tech Forum in the UK. This is Bloomberg. the AI talent war heating up, chips remain at the centre of attention for investors. Nvidia broke the $4 trillion barrier in its market cap yesterday, and TSMC is just seeing its revenue rise and rise. For more on the Bloomberg tech sector, let's speak to our Bloomberg Tech Europe anchor, Tom Mackenzie, on location at the Bank of America Breakthrough Tech Conference in the UK. Tom, what's happening?
Lizzie Burden, thank you very much indeed. Joined now by the chairman of Infineon Technologies, of course, supplying those chips, semiconductors around the auto sector and around industrials as well. Dr. Herbert Diess, thank you very much for your time. We have just arm-twisted you and dragged you out of a session where they were talking about AI. We were hearing from OpenAI, we were hearing from executives from Microsoft. How are you and the team at Infineon integrating AI solutions, and where are you finding efficiencies?
First of all, AI is not only for solutions very relevant for us. We are a big company, and you didn't mention that, in power supply, in power semiconductors. So the more power is needed in compute, the better for us. And we can offer solutions which really reduce the power consumption of those big server installations. So this is an area which offers good growth potential for Infineon, and we are very present there. We have all the new materials, so it's silicon carbide, gallium nitride. We can probably better than any other company of the world configure that to supply the power for ever bigger AI data centers. So this is, and then as you mentioned, also in applications in the company AI architecture. It's very relevant for us. Now, we are basically a knowledge company. We have a lot of deep understanding of processes. And there are sectors where we make really good advances, like in HR, where we can improve the quality, the responsiveness of the systems, also the happiness of our people who work for us, much better with the aid of AI.
How do you mentioned the energy efficiency piece. How do you see that story evolving in the next 1 to 2 years?
I think we can, and all the chip designs are now really focusing on power efficiency, and we are providing the energy to the compute, to the microcontrollers and computers, and so in this transition we can improve efficiency 10-15%, which is quite relevant.
And on headcount within Infineon, if we look at the back office, if we look at HR and other parts of the business away from the engineering and that deep knowledge base, are you capping headcount as a result of AI? What does it do for jobs in those parts of the business?
So far, we are still growing, but we are continuously looking for let's say better productivities and higher efficiencies as a continuous process, and AI will help us. I think it's in Germany it's even welcome because we have this constraint in, let's say, in qualified people, but so far the effect is really doesn't lead to any major headcount reductions.
On the question of tariffs, and we've had a reminder in the last 24 hours or so of the volatility around the tariff story. You're a global company. You supply into the US. You supply into China. Where is the pain point on tariffs for Infineon?
For us, it's very hard to judge still because the supply chains for semiconductors are really diverse. The semiconductor crosses so many boundaries on its way. It seems that there might be some impacts, but it's mostly on the finished goods side. So on semiconductors, it's not really to grasp so far, but there might be impacts.
What does it mean for pricing? Do you take the hit on margins, or do you pass that cost on?
I can't tell you about this. This is also decisions on the board level. I'm a supervisory board. No,
sure,
this is
sure.
company.
Look, you have the ear of government officials in Germany. Do you expect the EU to strike a deal with the US and soon?
I hope so. I think the EU is the biggest market. Now we have also some things to trade in, and so for the last signals we're quite positive.
And a baseline 10% tariff, if that came about, would that be manageable?
I would say that it always depends on what do you get against it, and this is a very complex tariffs. It includes all. Basically all materials you are trading in. So what is a good deal? I only think we can judge afterwards.
Look, you have deep knowledge of the Chinese market, previously in your role, of course, as the CEO of VW, and now at Infineon. What is demand out of China looking like?
Still, China is the economy worldwide which is fastest in transitioning into becoming an electric society. So electrification is really going fast. And this is one of the domains of Infineon. Now, this power supply. Also, electric cars, we can have twice the turnover than on a conventional car. So China is one of our major sales areas, and it's growing in our domains. It's still growing.
Is supply localization a challenge when it comes to the Chinese market?
We have some localized parts, but we're also exporting into China.
Yeah. I'm just thinking of the export control story that the US has applied, particularly to high-end AI accelerators. That's not where you sit as a market. But do you play out scenarios where those US export restrictions, when it applies to China, become ever tighter, more restrictive, and where they would enmesh?
They are. And over the past, I think they started some 7 years ago now, or 8 years ago, and they became ever tighter. It's always a question of give and take. Also, I think it's not in the interest of America to tighten too much, because they're selling also a lot of semiconductors into China. We just learned that some companies are specifying specific China chip designs, so the market will be there. And we have to comply with the rules, and so far I think we are managing through.
Okay, Dr. Herbert Diess, thank you very much indeed. Chair, of course, of Infineon Technologies. Thank you for your time. Lizzie.
All right, Tom Mackenzie, we thank you. And don't miss the next episode of Bloomberg Tech Europe, featuring an exclusive interview with the SAP CEO, Christian Klein. Catch that programme hosted by Tom Mackenzie tomorrow at 6:30 a.m. London time. Now, let's turn our focus back to trade and President Trump's tariff campaign.
We never had anybody in the White House that understood the numbers or were into it like I have. We've taken in hundreds of billions of dollars in tariffs, hundreds of billions, and we haven't even started yet. And it's going to be a great thing for our country. I think it's going to be a fair thing for the world. And we really haven't had too many complaints.
Well, the president has attracted one complaint over his tariff regime, and that's from the Brazilian leader, Lula da Silva. After Trump slapped the South American nation with a 50% levy over its trial for Jair Bolsonaro, Lula responded saying, "We're a sovereign nation and we won't accept tutelage." For more, we're joined by Bloomberg's Suzanne Lynch. Suzanne, good morning. You had Brazil with a trade deficit with the US last year. So is Trump picking a fight with Lula? And is Brazil really in a position to wage a trade war against him?
Well, I think this is an escalation, obviously, those comments by President Lula on the back of the criticism Donald Trump had channeled towards those BRIC countries over the weekend. This seems to have struck a nerve in some way. We are seeing this quite dramatic threat from Donald Trump here. It does matter for Brazil. We're already seeing coffee futures increasing this morning. Brazil is one of the main trading partners of the US. So this is quite serious. And I think what it's indicating as well is that Donald Trump, the logic of these trade moves, if you like, it's very difficult to decipher. Donald Trump himself has been talking about his ally, his political ally, Bolsonaro, the previous leader of Brazil, believing that he has been unfairly persecuted. So we have the sense now that Donald Trump is linking these two things. Also, we know that X, for example, had long-running and serious tensions with the regulators in Brazil over social media. This is obviously an issue that the Trump administration cares about, the regulation of social media in other countries. I'm thinking particularly here of the EU, where I am now in Brussels. The EU is a big regulator of tech. Does this mean that Donald Trump is linking those two things, for example, when he is looking at his options on trade tariffs?
And Trump followed the Brazil tariff announcement with 6 unilateral rates on nations from Libya to the Philippines. So what do we read into that in terms of who he's picking on now?
Well, I think he is. That clip we heard from earlier is showing that there is certainly a sense of a toughening of rhetoric by Donald Trump on this. He is mentioning the fact that the US has taken in extra billions in tariffs, obviously, because of these measures, but that he is not prepared at this point, it seems, to take the foot off the pedal. here in Brussels, for example, there is now a worry that with these other trade decisions and announcements that have come in the last 24 to 36 hours, does that mean that Donald Trump is going to follow through with more? We know that he has said that he's going to send a letter to the European Union, but I can tell you people are quite nervous here. They're wondering, when is this going to come? Is Donald Trump going to shift the goalposts on this at this point? Obviously, the EU is a massive trading partner of the US, and Donald Trump has been very critical of the European Union. They had been expecting to sign a provisional agreement by the end of the week. That's tomorrow. So let's see what the next 24 hours brings from Washington. It is undoubtedly the sense now for the rest of the world that they're looking on at this, that the ball is in Donald Trump's court now. People are waiting to see where he's going to strike next and what's going to come in the next day or so.
All right, Suzanne Lynch out of Brussels, we thank you for that update. But of course, tariffs hang over earnings season, which takes off today with Delta and its second quarter results expected alongside guidance for the full year before the market open. For more on what to expect, we're joined by Benny Camel, Bloomberg's managing editor for space and aviation. And Benny, are we sure we're going to get this today? Because, of course, Delta withdrew its outlook in April amid all of the tariff uncertainty then. And, July 9th has been and gone, and we've got barely any more clarity. So what are you expecting if we do get it even today?
So that will be the big thing that people will look out for. Will there be a new guidance? And if so, where will it come in? Just to remind people, we had a very strong start of the year. We had a very robust guidance. And then, as you said, in April, the company yanked that guidance and said there's so much uncertainty in the market that we really can't look into the back end of the year. So really expectations today are, will they bring back the guidance and what will it look like? We have heard somewhat more positive tones out of the aviation industry and out of Delta specifically, saying that things have stabilized somewhat. It seems that even though that the tariff issues are somewhat unresolved, people are sort of finding ways to navigate around them. They sort of accommodated around the tariff situation. So maybe the second half of the year, and that's really where the focus will be in terms of the commentary and what people will be looking for, will the second half of the year be more stable than the very up and down first half?
And I suppose the big question is who pays for tariffs, Benny? Because you've had Airbus and Delta making it very clear it won't be them. So who picks up the check?
Well, that's the big question, really. So who will pay? Airbus has come out and said, look, this is not for us to cough up the extra cost for these for the planes that we send your way. Delta has said the same thing, saying, well, thank you very much, we're not going to pay. So a bit of a checkmate there right now. Delta has found some ways in the past of sort of circumnavigating tariffs. You have to remember that aircraft and highly mobile equipment. So what they've done is they've used new aircraft, sent them to third-party countries like Brazil, and then declared them used and then flown them into the US. So there are some sort of innovative ways that you can get around it. And it will be interesting to hear from Ed Bastian, from the CEO of Delta, whether they're thinking about any of those kinds of tools again at this stage, because really it remains unresolved. This is an industry that's been without tariffs for many, many decades, and now suddenly this is a new reality they have to face. And even something like 10% would really hurt the global industry.
All right, Bloomberg's Benedict Camel, we thank you so much as we look ahead to those Delta earnings later on today before the market open. Now, let's get to some breaking news. OPEC has reinforced its view, an outlier even within the petroleum industry, that global oil consumption is going to be keeping increasing to the middle of the century. So let's get analysis now on that from Bloomberg's Jomana Basetchi. She joins us from the OPEC seminar in Vienna. Jomana, just talk us through what this means.
That's right. So a second day of the OPEC seminar, they just released the world oil outlook. And I've got to say, the takeaway is they're even more bullish than they were back in September on energy demand, forecasting that demand will continue to grow all the way up to 2050. So no leveling off. They see it growing by 19% to reach almost 123 million barrels per day. That is 3 million barrels per day higher than they projected back in September. And then they also specifically mentioned that the U.S. withdrawal from the Paris Agreement will impact climate change negotiations and would actually result in a higher demand for hydrocarbons. So for the group as a whole, for OPEC+, they're forecasting that their share of the market will actually increase from 48% to around 52% by 2050. So bullish on long-term forecasts. But I've also got to say, Lizzie, one of the other takeaways from being here the last couple of days is they're also pretty bullish on short-term demand as well. Otherwise, they would not have been putting all of these extra barrels to the market. That was the big theme as we came here from the weekends, the big upward surprise in the production barrels, and yet the market took it in their stride. We've heard from some of the biggest producers in the world, the UAE Energy Minister, Suhail Mazroui, saying that the market actually needed these extra barrels, that inventories are still sitting pretty low. Even Aramco have actually raised their official selling prices to their customers around the world, including Asia buyers. So at this point in time, it does really reflect a market that appears to be tight. How that's going to change and evolve in the next coming months is a big question, because many analysts out there do think that we're going to hit a supply glut by the end of this year.
All right, Jemana Becerchi, fantastic reporting. We thank you so much. On the ground for us at the OPEC seminar in Vienna. And just looking at the oil price there, we're just shy of $70 a barrel off the back of that report. But we've got lots to factor in here. The tariff headlines, we've got the fresh attacks on Red Sea shipping. Houthi attacks have sunk 2 cargo vessels and left multiple crew members dead. You've got Brent futures just shy, as I say, of $70 a barrel here as we digest these headlines. So pretty steady, actually, as things stand. A look at what's ahead today. We'll get those Delta earnings later on for a sense of what's happening in the travel space. We'll also get a fresh read on the economy with the initial jobless claims data coming later in the morning. And at 1 p.m. Eastern Time, the US Treasury will kick off that third in the trio of auctions. Yesterday's went pretty well. But that is where we're at the moment. Checking in on your futures space, still pointing to the downside as we head towards surveillance. That's it for your Bloomberg Brief, and this is Bloomberg.